I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, May Day stocks have their worst monthly performance so far this year, with tech, from chip makers to the FANGs, feeling the pressure, and U.S. stocks posting their biggest weekly slide since December. Plus, retaliation. China will establish a list of, quote, unreliable foreign companies it says hurts the interest of Chinese firms. What the sweeping order means for the biggest names in tech. And Uber and Lyft still holding ground in the Big Apple. How New York City's efforts to curb traffic from ride-sharing apps fell flat. First, to our top story, U.S. markets posted a dramatic slide today as global trade fears once again spooked investors. U.S. stocks extending a weekly loss, the worst since the end of last year, while Treasuries rallied a fourth day as the Trump administration's trade spats intensified, now on multiple fronts, not just China, but Mexico. The S&P 500 also capped its worst month of the year. I want to bring in Mike Regan, senior markets editor for Bloomberg in New York. So, Mike, lots of different things going on here. Tell us where we saw the bloodshed and why.
Well, the bloodshed was pretty widespread, Emily. 9 of the 11 main sectors in the S&P 500 were down. And it really stems from the surprise announcement of potential tariffs on Mexico. Now, it's no surprise to anyone that President Trump is sort of ratcheting up the immigration rhetoric with Mexico. But the U.S., Mexico, and Canada had a trade deal that I think most of the market had assumed was near the finish line. It was recommended to go to the Senate in Mexico by the president there last night. It was believed that the U.S. Congress would be voting on it soon. So that calls that into question, and it really casts a shadow even on the future of China-U.S. trade negotiations, since it's now clear President Trump is capable of a major surprise, even when it seems like a trade deal is ready to be signed.
So, what could be, another triggering event here? We've got a lot of new actions being taken by the Chinese and also some new threats.
Yeah, I think, as you mentioned at the top of the show, China overnight basically warned that it's going to create its own blacklist of U.S. companies that it deems to be unreliable trade partners. I suspect that even without the Mexico tariff announcements, that we would have seen some weakness in technology, specifically chip makers and equipment makers, that sort of thing, because of that news. Now, China didn't say what companies would be on this list, but it's widely believed to be a reaction to the blacklisting of Huawei. So the assumption would be that technology companies would make up a pretty large amount of the companies on this list. And we'll just have to wait and see if China actually does release this list and who specifically is on it. But investors, I think, are not taking any chances. They're avoiding the tech stocks just in case the one they own is on that list.
Let's talk about chip makers in particular. Of course, they've, in the U.S., been hit by the blacklisting of Huawei. So companies like Qualcomm, Broadcom can't supply Huawei with chips. And of course, there are broader issues facing chip companies in general, given the tariff issues. I have a chart here in my Bloomberg which shows what the chip sector is looking like, set for the worst month in now more than 10 years. Tell us about some of the dynamics in chips in particular.
Well, I think it just very much speaks to the uncertainty in the markets right now. It's very hard for companies to plan their supply chains right now when they don't know if these tariffs are permanent, are they temporary, or the tariffs with Mexico a bluff. So with the chip makers specifically, the companies are having a hard time planning their supply chain. So investors obviously are having a hard time deciding which ones to own, if they should own the space at all, or if we're in for sort of this so-called tech cold war that a lot of people are talking about.
So let's talk about the big tech companies in particular, Apple, Alphabet, both ending the day down. It's interesting because, of course, Apple has huge exposure in China. Alphabet less so, though, is more exposed in the situation with Huawei. What are the particulars that you're watching here?
Well, I think you have to look at, the performance of these companies and their sort of role as the big heavyweights in the stock market. What we saw today was very much a macro reaction. In other words, people worried that if the trade war escalates and spreads to Mexico and the Chinese situation is nowhere closer to being resolved, the whole market's coming under pressure. And I think when you look at an Alphabet, an Apple, and an Amazon, pretty widely owned in a lot of portfolios, stocks that have been, at least until recently, been strong performers. It's the type of thing that's going to lead on the way up and lead on the way back down when there is sort of this mass selling like we've seen today.
Now, given the uncertainty, given that both the U.S. and China seem to be digging in their heels for potentially a very long-term fight, we've seen this big drop, but could it also mean that if things got better, a correction could be imminent?
Yeah, a correction to the upside, you mean? I mean, certainly. I think right now there's so much guesswork being done. A lot of people assumed that weakness in the stock market would lead President Trump to sort of back off on the trade rhetoric. That's clearly not the case. A lot of people talk about this so-called Trump put. In other words, how much they think the stock market would have to fall in order for him to sort of rush a trade agreement with China, back off on some of the other trading partners. It's clear now that that put is not as where people thought it would be. They expected a few percentage points drop in the S&P to really make President Trump tone down his rhetoric. And it's just escalating. But I think if you're going to use that put as a metaphor, it's also important to talk about the date. Puts always come with a date. And right now is a time, I think, in the election cycle where President Trump can afford some market weakness, so he can afford to get tough. As the election draws closer and the campaign season draws closer later this year and early next year, it'll be interesting to see if he sort of gets resolution on these issues by then in order to have that stock market as a tailwind to his re-election hopes again.
All right, Mike Regan, who leads our markets coverage. Lots going on. We'll see what next week brings. Thank you so much, Mike, for that update. Meantime, ahead of its direct listing, Slack revealed its first quarter financials. According to regulatory filings, the company lost $31.9 million in the period, while revenue grew 67% to just under $135 million. The startup, which charges companies for special features for its messaging software, is planning a direct listing on the New York Stock Exchange in coming weeks. We should disclose that Bloomberg Beta, the venture capital arm of Bloomberg LP, is an investor in Slack. Coming up, hitting back, we've got new details on how China plans to retaliate to the U.S. ban on Huawei. And if you like Bloomberg News, check us out on the radio. Listen to the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. It's been a week dominated by trade. On Friday, President Trump announced tariffs on imports from Mexico in retaliation for people crossing the U.S. border illegally. Hasn't materialized yet. Meantime, China announcing it would be compiling a list of, quote, unreliable entities to sanction in retaliation for the U.S. blacklisting of Huawei. China raised tariffs on tens of billions of dollars of goods imported from the U.S., making good on its promise to retaliate against President Trump's latest round of trade war duties on about $200 billion in Chinese imports. Joining me to break it all down are Bloomberg Tech executive editor Tom Giles and Rebecca Fannin, founder of Silicon Dragon, a media and events platform and author of a new book, Tech Titans of China. So, Rebecca, the Chinese are digging in their heels here and seem to be gearing up for a long-term fight. You've got messaging coming out of state media that experts are saying this could last until 2035. What's your take on the level of seriousness here?
I think it's gone from D.C. and Beijing to spreading out to Silicon Valley and other aspects of our economic lives. And I think we're just at the beginning. I think certainly the rhetoric has really become much heavier, and I think we're really in for a long run.
This list of unreliable entities, Tom, is rather vague, and it could expand to multinational companies that aren't just based in the United States, but based in Japan or
everywhere.
the UK. What are we thinking the
Samsung,
impact could be
Toshiba.
here?
I mean, the sky is the limit, right? It's very vague. We don't know exactly who's on that list, but it could include any number of companies that are, doing business between these two countries. You have companies like Intel and Qualcomm. Apple, of course, could be drawn into this in a profound way. Chip makers are exposed. Really, I mean, the ambiguity and the vagueness is part of what makes this so so terrible for U.S. companies, and creates this degree of uncertainty that's really weighing on the stocks throughout the market today.
Rebecca, what's your sense of how this could materialize or actually be executed on the part of the Chinese?
Well, I do think what we're starting to see is a separation of tech spheres, so that China will become much more dependent on its own technologies, and Silicon Valley, U.S., will become much more dependent on its technologies. And so we're going to see this separation of technology worlds. And it's really not a good thing for consumers or businesses, because prices will rise. And we will all, suffer. Innovation will suffer as well. So I think this is definitely not a good trend.
Now, I also want to talk about what's happening with Mexico. The president threatening 5% tariffs starting June 10th if the Mexican government doesn't take effective action on illegal immigration. I sat down with Nick Woodman, the CEO of GoPro, a few months ago, and he talked about how they had moved some production from China to Mexico as a result of what was happening between the U.S. and China. Take a listen to what he had to say.
We said, let's go research where else we would build our products for the U.S. market. We landed on Mexico, and as through our research, we learned that there were also financial benefits, logistical benefits to doing so anyway, regardless of tariffs or no tariffs. So whether or not the tariff threat to our product category becomes real, we're happy to be moving our U.S.-bound production to Mexico.
Well, the tariff threat on China is real, and we don't know what's going to happen with Mexico. But
That's right.
Now they're stuck between a rock and a hard place.
Right, and I think Rebecca hinted at this earlier, you're seeing, and what you're going to see is the emergence of different supply chains. So much of production, particularly in consumer electronics, which is a topic that we think about and talk about all the time, Emily, has happened through China. But now, given the trade tension between the U.S. and China, companies like GoPro, like Nick Woodman was saying, have to look elsewhere. Where can we source our products? Where can we finish our products? How can we move the supply chain out of China? We talk to companies every day who are telling us we are looking to increase capacity for production outside mainland China, whether that's Southeast Asia, whether that's Taiwan, whether that's Mexico. They're doing that. And now what they're seeing is, oh no, Mexico's not a safe place either. And so that's going to really affect the automakers, and it's going to affect a lot of consumer electronics companies like HP, Dell, potentially, which do some of their production south of the border.
Now, we've talked a bit about this tale of two tech industries, or tale of two internets, certainly between the U.S. and China, and to some extent, it already exists with the firewall in China, the many U.S. technology companies that are blocked or don't do business in China. But Rebecca, if, let's say, somehow a deal is struck down the line, can they ever return to the prior sort of state of affairs? Or will this dispute, will this war essentially be fresh?
Well, I think the whole uncertainty of it now is causing companies to really refigure and re-strategize their whole plan, and so they will having to have new alternative sources in place, and so that will be hard to unravel. And so just like now, these global supply chains, they're so intertwined, even that is going to be hard to break apart. So anyhow, it's just very complex time.
Meantime, Tom, the president is planning to visit the UK, have a talk with outgoing Prime Minister Theresa May about Huawei specifically, and to express his concerns because the UK is at a sort of fork in the road where they're considering using Huawei equipment in some of their commercial networks.
That's right.
What do we expect to happen there?
So you have this huge build out in 5G, this next generation of wireless technology that's going to enable this ubiquitous wireless coverage. And a lot of companies and a lot of countries are still really dependent on Huawei, which is the leader by a long shot in this area. And the US has had a hard time getting European allies on board with their "you must ban Huawei" rhetoric. Their view is it's better, it's more economical, and you have not proven to us that Huawei really represents a national security threat for us in these countries outside of the US and even in the US, by the way. So there are a lot of European countries that are not on board with it. And that's what I think his message is going to be when he's in Europe is get on board, Huawei's a threat, ban Huawei, go elsewhere.
All right, so many moving parts. Of course, we'll continue to follow this through the weekend and give you the latest on Monday. Tom Giles, thank you so much, along with Rebecca Fannin of Silicon Dragon. Meantime, Tesla has started taking orders for Model 3s to be made in China, lowering prices as it seeks to double down on a market that could drive future growth and revenue. Bloomberg's Tom McKenzie has all the details from Beijing.
The California-based company set the base price for its China-manufactured Model 3 at just over $47,500, including taxes. That's almost $7,000 cheaper than the imported version. The cars, to be built at Tesla's Gigafactory in Shanghai, will have a range of 460 kilometers or 286 miles per charge. They're expected to be delivered in 6 to 10 months. Tesla said it will introduce V3 superchargers in China by the end of this year, cutting charging times to around 15 minutes. The company currently ships all its cars from the US, meaning they're subject to import tariffs and miss out on Chinese government subsidies. Elon Musk is counting on Tesla's Shanghai factory to bolster competitiveness in a country crowded with hundreds of electric vehicle rivals. In Beijing, Tom McKenzie, Bloomberg.
Coming up, a new report says Amazon considering getting into the wireless industry, but it was a bridge too far for one Wall Street analyst. We'll have him explain why next. This is Bloomberg. Could Amazon be eyeing yet another new business? Telecom? The online retailer is reportedly interested in purchasing prepaid wireless phone service Boost Mobile from Sprint and T-Mobile. The deal would allow Amazon to use the network of the combined entity for at least 6 years. The idea, however, is a bridge too far for one Wall Street analyst. MoffettNathanson's Craig Moffett has 30 years of experience in the telecom business and calls the potential tie-up just crazy. He joins us now on the phone along with our Bloomberg Tech editor, Alistair Barr, here with me in San Francisco. Craig, first of all, you didn't call it just crazy. You called it expletive crazy without the use of any expletives. Explain to us why.
Well, first, let's back up a little bit and remember what they're trying to do here. In order to get the Sprint T-Mobile merger done, the Department of Justice, at least it has been reported, will require the creation of a fourth competitor. And so what you're talking about is making Amazon a fourth competitor. The point I was trying to make was making Amazon the fourth competitor in the market isn't sensible either for Sprint T-Mobile or for Amazon. For Sprint T-Mobile, the idea, or for T-Mobile, let's say, the idea of taking a four-player market down to three and then taking it back up to four so that your fourth competitor is Amazon instead of Sprint is clearly not a better situation. So just strategically, that's not a terribly sensible idea. And for Amazon, the problem is you can't differentiate a telecom network that's a proprietary network and still have cost advantage, because cost advantage in network operations requires system loading. That means opening the network to everybody. You can't have it both ways. So it strategically doesn't seem to make sense for anybody here.
Now, Ali, we know that the DOJ has been leaning against approving the T-Mobile Sprint deal, and so they've been trying to make some concessions to get the DOJ on side. But what exactly is being reported about Amazon's interest in Boost?
So that was a Reuters report, which was several unidentified people familiar with the situation, we write similar stories as well. We haven't been able to confirm that one, but what we have confirmed is kind of what Craig mentioned, which is that the DOJ said, yeah, you can do this deal, Sprint and T-Mobile, but you have to make some concessions and basically they have to divest Boost Mobile, which is this reseller of their existing spectrum, their network, and then they also have to actually sell some spectrum as well. And the Reuters story said that Amazon would be interested both in Boost Mobile and this spectrum as well.
Now, Craig, Citi seems to be on side saying this is a negative for all wireless carriers. That said, Amazon has branched out into unexpected businesses in the past, has transformed those businesses. The cloud business, the buying Whole Foods was certainly unexpected. Why would this be something different?
Well, again, let's remember that we're talking about the perspectives of all the different parties here. So, from the perspective of the carriers, again, inviting Amazon into your industry is not something that people are particularly want to do. So, I think it's understandable why the market reaction today for all the other telecoms was so negative, because even though the suggestion that Amazon might enter the telecom business is not a terribly attractive idea for anyone in telecom. But for Amazon, again, to try to maintain a national network. Remember, the AT&T and Verizon, to take two examples, have spent $200 billion each over the last decade or so in capital investment and spectrum purchases. So you're talking about a pretty significant ante, even for a company the size of Amazon. Nobody in wireless has ever earned much better than the cost of capital as a return. So it's a very low return, reasonably unattractive industry, and that's even before Amazon comes in with an aggressive price strategy. And once again, in order to make this say you want to use it for drones or driverless delivery vehicles, you're going to have to load that network with other people's traffic, lest it be simply not sufficiently utilized and therefore have excessively high unit costs. So if you're going to load it with other people's traffic, it's not differentiated and it's not a basis of competitive advantage anymore.
All right. Well, expletive crazy. Your words. Craig Moffett of MoffettNathanson, always good to have you here on Bloomberg's Alistair Barr. Thank you. Coming up, as the U.S.-China trade war continues to escalate, venture capitalists may be forced to change their strategy. We will tell you how next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Let's recap our top story. May turned out to be a month to forget for U.S. equity investors. The S&P 500 posted its worst month of the year, falling for 4 straight weeks. The benchmark delivering its worst May return in 7 years and the second worst since the 1960s. For tech traders watching the NASDAQ 100, it was no better. That index falling to the lowest level since the end of March and its worst month since December. Baidu, Nvidia, Qualcomm, Tesla were among the biggest laggards of the month. Meantime, 2018 was a record-breaking year for venture capital, with the rise of supersized funding rounds and astronomical deals. But this year, one venture capital firm actually said no to more cash. Consumer-focused venture firm Maveron just announced its 7th fund, closing on another $180 million. But to keep the fund smaller, Maveron says it turned away $70 million. The firm has backed companies like Allbirds, Everlane, eBay, among other direct-to-consumer startups. Joining us to discuss, Maveron partner Anargia Vardhana. Thank you so much for joining us.
Thanks for having me.
So why turn down $70 million?
You know, in an era when funds are raising more and more money, we thought that for us, it's about being disciplined, being focused, and that is a small fund size, highly focused strategy, focus on only consumer, and really living by that. And so turning away over $70 million, focusing on our $180 million fund was our way to really exemplify that.
Do you think you couldn't have found enough good consumer bets to invest in if you had taken that much money?
So the ubiquity of consumer deals to do, there's a ton to do, and I think we're seeing a lot of great deals. Maintaining our small fund size really allows us to be focused on what really matters. We believe that every year there's going to be 1 to 2 top consumer deals that matter, and we laser focus on our time, our efforts, entirely around sourcing those deals.
So what are the top 2 deals that matter right now?
Well, we're spending our time looking for those. If you have any suggestions, let me know. But we're looking in very specific categories and think that there's a lot to happen in these legacy industries and brands where there's no consumer loyalty, there's no consumer interest, and it actually is a consumer pain point. You could think of industries like healthcare, insurance, the way people access and think about their finances, all industries that are ripe for a great, strong, consumer resonant brand.
So where have you put that money then in the last year?
Yeah, we've been spending a lot of time looking quite broadly in a number of different categories. Consumer healthcare has been something of deep interest for us. If you think about the reproductive rights of women and the number of different areas in a woman's life that she thinks about a reproductive system and the different ways in which she accesses it, we're investors in a company called Modern Fertility. Modern Fertility is a brand entirely focused on the woman's fertility and her ability to understand where she is in that and make choices and feel empowered with that data.
So what's your take, given that laws are advancing to potentially curtail women's reproductive rights, and you've got a company like Netflix saying, we won't work in the state of Georgia if this happens?
So we think that a lot of amazing founders are out there figuring out what are the ways in which companies can enable consumers to have content, community, commerce, ways in which they can take control of their own health, whether that's something like Modern Fertility or a seed investment in a company called Bloom that's empowering teens right when they start their period. There's a ton of opportunity to really serve the consumers at their point of need.
Meantime, we've been talking a lot about trade, and how do you think what's happening between the U.S. and China, and now potentially the U.S. and Mexico, is going to impact the VC industry?
Yeah, in the consumer space thus far, the huge impact has largely been in the agricultural sector, and it hasn't gone yet to really impact some of the early stage consumer startups. That being said, we're seeing companies in the consumer electronics, consumer physical products moving away, or at least thinking about contingency plans for what happens should the trade wars magnify and amplify. And that's looking for a diversification of their supply chain, of their manufacturing, and making sure that they have plans really set around that.
So how are you thinking about this internally as a firm? Is it changing or impacting the decisions that you're making?
It's a board conversation, and making sure that that conversation is happening at the board level amongst our portfolio companies, especially ones with physical products, and bringing that up and ensuring that those plans are in place for when the companies need to address something that's happening amongst the two countries.
Now, you've got 6 partners at the firm, half men, half women. How did you do that, since other VC firms seem to find it so difficult?
They do. So we are really proud to announce that with this $180 million fund, we are gender split 50-50, and we are intentional and deliberate in making sure that we have a gender split in an industry where only 11% of check writing partners at venture capital firms are women. We're proud of our 50-50 split, and that really shows in our results. We get an unfair advantage in finding companies, understanding areas of business, understanding areas of consumer, with women controlling 70 to 80% of consumer dollars. We think it's our advantage, we think it's our ability to win, and it really aligns with our values of winning the right way.
You recently did a thought experiment around Facebook and the potential unbundling of Facebook. You got a bunch of founders together to talk about it. What did you learn there, and how will that drive your investment strategy?
Yeah, we're thinking a lot about all the behaviors that take place on Facebook, and some of the behaviors are not well accommodated for on the platform, and we believe that they can be broken out and made into their own billion-dollar businesses. An excellent example of this in the past has been Discord, where that behavior of communicating could have lived on Facebook, but Discord is now its standalone business. And so as we look at other opportunities on Facebook, these massively engaged communities, whether that be around people living with a certain type of chronic illness, immigrant communities, recommendation engines, whatever it may be, we think there's opportunities for these behaviors to be broken out, live as their standalone company, and build something highly engaging and compelling for people.
So do you think there could be a new social network?
Yeah, I think that the way we think about it is, how are people engaging in their day-to-day lives, online, offline, and what are the needs that they have, and what are the companies, the products, the services, the applications that will enable them to meet those needs?
All right, Anarghya Vardhana of Maveron, thank you so much for stopping by.
Thank you
Good
for
to have
having
you
me.
here
Take
on the
care.
show. All right, NASA is giving a new optimistic timetable for returning to the moon, with astrobotic launch dates set for the summer of 2021. On Friday, the agency selected 3 commercial companies to send a series of robotic landers with NASA equipment to the moon. This as it prepares to land humans on the lunar surface by 2024. Landers from Astrobotic Technology, Intuitive Machines, and Orbit Beyond will be the first American spacecraft to complete this mission since Apollo 17 in 1972. Coming up, New York City has been one of the most challenging cities for Uber and Lyft to navigate, but regulatory battles and price hikes seem to have had little impact on slowing them down. We will discuss next. This is Bloomberg. Facebook CEO Mark Zuckerberg's personal security chief has been placed on administrative leave amid allegations he made racist and homophobic remarks. A spokesman for the Zuckerberg and Chan family office said Liam Booth, a former Secret Service agent, has been placed on leave while an outside law firm investigates. According to regulatory filings, Facebook's costs for Zuckerberg's personal protection totaled nearly $10 million in 2018. Shares of Dell tumbled 10% in Friday's session, its worst performance since December of last year. The company posting sales weaker than estimated and projected even weaker demand for the company's servers. Bloomberg's Jonathan Farrow spoke with Dell CFO Tom Sweet earlier today about the results and his outlook on the ongoing trade dispute.
Well, I think what we have been talking about over the last 12 to 14 hours is how do we think about our flexible supply chain? As you know, Jonathan, we have a large global supply chain, 25 manufacturing sites around the globe. And so what we're trying to think our way through right now and analyze is the impact of this and how do we mitigate it. You know, we've been successful in mitigating the first 3 lists that were related to China, and we're working on the 4th list if that comes into fruition. And now we'll have to work our way through the Mexico dynamic that's got announced last night.
So, Tom, let's try and do that now. And I know that we can't have some kind of conclusive, definitive conversation, but you learned the potential for tariffs. I believe you have some assembly down in Mexico. Just how nimble is that supply chain and that exposure to Mexico? How flexible is it if you wanted to move it?
You know, over a certain period of time, we're quite flexible. Obviously, you can't react to something like this in the course of a week or 2 weeks, but we have shown the ability to maneuver as we've gone through the political dynamics that we've seen over the last, 6 months to a year. So, with an appropriate amount of time, it's very flexible, and we'll work to minimize it. I will tell you, though, that to the extent that we can't minimize it, there is obviously some work that we'll have to do around our pricing framework as we think about the impact of those tariffs.
Well, Tom, are you expecting to absorb this at a margin or hand it over in price to the end consumer? What are your thoughts on that?
Well, I think we'd like to minimize and mitigate it as best we can, but I will say that to the extent that we can't, I mean, it does put pricing pressure on us, and you would probably see us react by adjusting prices appropriately.
Well, let's talk about how that's worked out in China at the moment. I know there's some very different specific issues to the Chinese market at the moment. Some area of disappointment was just server demand, Tom. What's happening? And is it a Dell story or a broader story?
Well, I think, we're coming off an extraordinarily strong year in servers and networking last year, and I think our business overall for the year was up 28% year over year. As we walked into this year, we knew it was going to be a softer server year, just given the investment cycle. I think what we've seen, it was softer than we expected, and we saw it in pockets. We saw it in China, where we saw softness in the server market, and we saw certain large, I'll call them large hyperscale type deals that were extraordinarily, that were perhaps profitable a year ago, not profitable this year, and we decided that that wasn't a business framework that we wanted. So we declined that business. And so I think what we're thinking our way through right now is that, the environment is changing, and it is, investment cycles are changing. We're still optimistic about the year, but we'll have to manage and mitigate as we go through, and we'll balance that revenue and profitability framework as we move through through the year.
Tom, got to talk about the debt load as well. How high a priority is that at the moment? We've just seen some big outflows from investment-grade debt funds, seen some pressure in high yield as well. Things just don't seem to be as comfortable for companies that carry big debt loads than, say, maybe they were a couple of years ago. How big is the focus to really look at addressing that debt situation?
You know, it's high on our list. We've been paying down debt quite nicely over the last 2.5 years. We've paid down $15 billion of debt. You know, I think, and so while people look at our balance sheet and say you have a fairly sizable amount of debt, I think the thing you also have to remember is that we have a fairly strong and big cash flow and EBITDA generation. So we're comfortable with our ability to manage our debt load, and we're continually focused on paying down debt and getting back to investment grade over that 18 to 24-month period.
Tom, got to wrap things up with some optimism from somewhere. It's a depressing morning for so many people. Where's the optimism for the team at Dell?
Look, we're optimistic about our business, about our broad-based set of capabilities and solutions. You know, customer receptivity to our capabilities is strong. If you look at our quarter, $22 billion of revenue, 2% revenue growth. We grew operating income to $2.2 billion, up 8%. Look, we'll have to navigate through the year as we work our way through some of these macro dynamics, but we think we're well positioned and really pleased with our client business, pleased with our storage velocity and demand, and we'll work our way through some of those other sort of dynamic spots as we move forward.
Tom Sweet there, the CFO of Dell. Well, over the past year, New York City has cracked down on ride-sharing apps through license limits and other legislation. But the city's efforts to curb traffic haven't slowed demand. According to Bloomberg analysis of the city's Taxi and Limo Commission, Uber and Lyft both completed a record amount of trips last March. Joining us to discuss in New York, Bloomberg, Shelley Hagan. So, Shelley, how much are Uber and Lyft still growing in New York City, despite the efforts of some city officials?
Thanks, Emily. So, Uber and Lyft completed a record number of trips in March. This is despite New York City's efforts to curb congestion and traffic caused by ride-hailing apps. In March, Uber completed more than 17 million trips in New York City, which is the most it's ever completed. And Lyft also had a record month with 4.7 million rides. And again, this is despite New York City's efforts in the past 12 months to kind of curb down on the congestion and traffic caused by these apps. Earlier in August, New York City is limiting license to new drivers of the ride-hailing apps. And then earlier this year, minimum wages was set for drivers of Uber and Lyft, and we've also had some congestion surcharges on passengers in ride-sharing apps. So prices are going to be raised for Uber and Lyft, yet we haven't seen in the data yet that rides are slowing down. People are still taking a record number of trips.
So could it be that Uber and Lyft could be impacted down the line as some of these measures pile up and go into effect?
I think it's possible to see down the line Uber and Lyft could be impacted, but it's too early, I believe, in the data to see anything because it's been less than 12 months that New York City has kind of clamped down on the ride-hailing apps, and we only have data from the Taxi and Limousine Commission since March. I think it'll take a few more months to see whether or not the rides keep increasing and Uber and Lyft keep growing faster, or if it's starting to slow down and people are really starting to take into consideration the higher prices that they're paying for these apps.
Is New York City showing any signs of relenting in its sort of turf war with Uber and Lyft?
New York City seems to be continuing to clamp down on ride-hailing apps. They understand that the taxi industry has been hurt by ride-hailing apps. Actually, in the past 2 years, yellow taxi rides have dropped 22%, while Uber and Lyft have had continuous growth. And I think just the number of rules that have gone into effect in New York City in the past year really show that they're trying to do something to limit traffic and congestion and alleviate some criticisms that drivers of ride-sharing apps aren't being paid well.
So obviously New York is a huge city, but Uber is a global company. Lyft is a national company. They're also experimenting in Canada. How big a deal would a pullback or even a slight pullback in business in New York City for them actually be to their overall bottom lines?
New York City is a huge market for both Uber and Lyft, and any impact really any city that's going to clamp down on ride-hailing apps is going to be a big financial concern for both Uber and Lyft. Actually, because Uber and Lyft both went public this year, they've listed in their company financial statements that any regulation around ride-hailing apps in their business would be concerned and would be a financial concern for them.
All right, Shelley Hagan for us in New York. Thanks so much, Shelley.
Thank you
for that reporting. Still ahead, at the Worldwide Developers Conference next week, Apple will make the case it's growing beyond the iPhone. We'll bring you a preview next. This is Bloomberg. Huawei overtook Apple earlier this year as the world's second largest smartphone maker. Still, the Chinese firm is pushing back against talk that its American rival could be targeted in the trade war. In an exclusive interview with Bloomberg, Huawei founder Ren Zhengfei told us why he still considers Apple to be his teacher.
那当然呢，苹果是这么大，对吧？
And Apple is as big as this. We became a peach over the past few years, a bit bigger than an apple. We might become a plum in coming years, smaller than an apple, but still edible. A plum is just a little bit sour and bitter.
带一点酸味，苦涩。我可以变大，也可以变小。
We can become bigger or smaller. We are not a public company. We are not only pursuing growth or profit. It's good enough for us to just survive.
我们存活下来就是不错的。
There have been calls by some in China for Beijing to retaliate against Apple. Is that an action that China should be looking at taking?
绝对不会，这是第一点。
That will not happen, first of all. And second of all, if it happens, I'll be the first to protest. Apple is the world's leading company. If there was no Apple, there would be no mobile internet. If there was no Apple to help show us the world, we would not see the beauty of this world. Apple is my teacher. It's advancing in front of us. As a student, why should I oppose my teacher? I would never do that.
Well, you've talked about having a 2-year lead in terms of 5G on your competitors. Does that lead get eroded?
Definitely. If we slow down, it's because the wing of the airplane has lots of holes. If we fly slowly but others fly fast, of course they can catch us up. But we will keep fixing the holes. We will fly fast again once all the holes are fixed.
What exactly have you put in place in terms of contingencies? Can you just give us a few more details around the contingencies that have been put in place?
核心在这个飞机的发动机油箱里面，有可能我们做了准备了。
We might have contingency plans for the core of the airplane, the engine and fuel tank, but we may not have a plan for the wings. We need to review the situation all over again and fix those problems. You can come back to interview us in 2 or 3 years to see if we still exist. If we're gone in 2 or 3 years, please remember to bring a flower and put it on our grave.
What colorful use of metaphor is Huawei founder Ren Zhengfei speaking exclusively with our own Tom McKenzie. You can catch the rest of that exclusive news-filled interview at Bloomberg.com and on Bloomberg Television this Saturday in a special Huawei Connected and Contested. Sticking with Apple, the company is thinking about life beyond the iPhone. They will showcase their new strategy for devices and software at the annual Developers Conference next week. This according to sources who say the announcements will range from updates that let Apple Watches work more independently from the iPhone to apps that run on Apple devices. Joining us for a look ahead, Bloomberg's Mark Gurman in LA. So Mark, raise the curtain for us. What are we going to see?
Yeah, so this is going to be a very significant conference and set of announcements for developers, but specifically people who are really focused on the Apple Watch, the iPad, and the Mac. This is not going to be a big day for the iPhone, and it's a little surprising given that the iPhone makes up about 2/3 of Apple's revenues. So on the iPad, you're going to see new Pro features to push people away from the Mac towards what they call the future of computing. We're likely to see a preview of the new Mac Pro. This is going to be an ultra expensive modular desktop computer geared towards video editors and developers. And you're going to see the Apple Watch get a bit more independent now with new apps like voice memos, a calculator, as well as an onboard app store for the first time.
And what about the new unified app strategy? How will we see that rolled out?
Yes, that's going to be the entree of the event. They're likely going to call this universal apps. It's a term they've used before. And basically, just to break it down for you, right now, if you're Apple or a third-party developer and you want to be on Apple's multiple platforms, because they have a few, you would write an application, one that runs on the iPhone and the iPad. And if you want to be on the Mac, you would run a separate app on the Mac, right? But what that does, that takes away a lot of time that you could be focusing on new features and design by having to write completely two different applications. Now what Apple is trying to do is merge that. So you write one application that can run on an iPhone, an iPad, and a Mac. And eventually this can spread to all other devices like the Apple Watch and the Apple TV as well.
So let's not forget the iPhone completely. What about the iPhone's new features? 20 seconds.
The iPhone's new features will be a new dark mode. You'll have a new health application that's redesigned, other new bells and whistles, but the interface is going to look very similar to the current version of iOS.
All right, Mark Gurman, thanks so much for breaking it down. Our very own Mark Gurman in LA. And that does it for this edition of Bloomberg Technology. Of course, we're live streaming on Twitter. You can check us out there. Follow our Global Breaking News Network TikTok on Twitter. Have a wonderful weekend, everybody. We'll see you here next week. This is Bloomberg.